Hey guys, we are kicking off a brand new month of investing and trading here at the Rich Retirement Letter. And you probably heard the statement, sell in May and go away. A lot of people think that if you get out of the market during the summer and get back in the fall, once school is back in session and the professionals are back at their desk, that you'll do better. But actually, if you get out of the market during the summer, you miss out on a lot of the historical returns that could be adding wealth to your retirement. This year in particular, I think we're going to see some really interesting opportunities for you to grow your wealth, but you have to know where to look in the market. For instance, we're seeing a lot of rotation out of the speculative, nosebleed, exciting stocks that people have been so keen on for the last year or so, the post-COVID rally. A lot of these speculative stocks have traded up to nosebleed levels, but now they're at risk of pulling back, and we're starting to see a lot of capital moving out of those stocks. Meanwhile, we're seeing money move into some of the more stable, reliable, dividend-paying companies, and these are the kind of investments that you want to be in anyway with your retirement, because they pay you a dividend while you hold them, and they also grow in value over time. So today I wanted to talk about 3 stocks that you can put into your account today in May to start this summer season and to generate wealth and income in your retirement. So we'll go ahead and get started with Bank of America. Let me show you this stock, this chart. As you can see, Bank of America has had a strong run recently, and I think this run is likely to continue. They just reported earnings, and one of the things that really helped Bank of America is that they were able to reduce their loan loss reserves. What this means is when you enter a crisis period like we had during the coronavirus crisis, big banks like Bank of America set aside money that they expect to lose if their loans go bad. But now that the economy is rebounding, businesses are doing all right, and these loans are being repaid, Bank of America is able to take that money that was set aside for risk and say, nope, we're actually going to receive this income from our customers. And so that has helped to increase their earnings. Meanwhile, the overall economy is doing well. Bank of America can lend more money, and interest rates are rising. The most recent report from Bank of America said that if interest rates rise by 100 basis points, that's 1%, it will add $10.5 billion of annual interest income for Bank of America. That's net interest income. So we're seeing a situation where as interest rates start to rise, Bank of America's earnings could pick up big time, and that could continue to drive this momentum higher. Now, the company is only trading at 14 times next year's earnings, which is a significant discount to what most stocks in the S&P 500 are trading at. Meanwhile, you get a 1.8% dividend yield with Bank of America. So you're getting some good income while you're also getting a stock at very cheap levels compared to what they're supposed to earn. And keep in mind, as we move through the year, a lot of these big banks are going to be allowed by the Fed to increase their dividends and to increase their share buybacks, which will help drive the stock higher and give you more income for your retirement. The second stock that I wanted to look at is Intel, ticker INTC. As you can see, Intel had a little bit of a pullback over this last month or so, and part of this is a really well-documented shortage in computer chips, and that's what Intel makes. So Intel actually announced that they were going to see some profit margin decline. In other words, they're not going to make quite as much money for every dollar of revenue that they generate. But at the same time, this chip shortage should keep demand for Intel's products high. And over time, as Intel is able to provide the chips that so many customers want, especially in the automotive industry, we're going to see Intel move higher and their profits increase. Now, so I think that this chip shortage is more of a short-term problem than a lot of investors are giving it credit for. Meanwhile, you can buy Intel for about 12.6 times next year's earnings, which is a deep discount to what you're paying for most other stocks in the market. So again, you're getting a quality company at a discount price, and Intel pays a 2.4% dividend. Now, keep in mind, as Intel pays this 2.4% dividend, they're only paying a small percentage of the profits that the company generates year in and year out. So there's plenty of room for Intel to increase its dividend over time, and there's also plenty of a safety net in case things don't go quite as planned with Intel. They'll still be able to continue to pay their dividends. So you're getting some great income for this play. The third one that I want to talk about today is Vale S.A, ticker VALE. Now, this company makes iron ore, they mine copper, they also mine gold and silver, which makes this a great play if you want to protect your retirement against inflation, because all of those things will move higher as inflation kicks in and the value of the dollar is under pressure. Meanwhile, keep in mind that we're going to have a lot of infrastructure projects, not just here in the United States, but around the world as the global economy looks for ways to generate more activity and to help pull many different countries' economies out of the muck. So we expect to see a lot of infrastructure, which will drive demand for iron ore and copper. Also worried about inflation, which will drive demand for gold and silver. And you can buy shares of Vale at just 6 times next year's earnings. So you're getting a steep discount for this stock. Meanwhile, keep in mind that as the value of their underground resources moves higher thanks to inflation, the actual value of the stock should move higher just because what they own is more expensive, is worth more. So again, you're getting the stock at 6 times earnings, and you're also getting a 5.9% dividend yield from shares of Vale. With this type of a dividend yield, you can expect the stock to be, or the investment to be a little bit more speculative. But again, we're seeing some big trends that are helping to move Vale higher, and we expect those inflationary trends to continue to drive more demand for material stocks like this. So these are 3 ways that you can actually take advantage of what the market is offering us here in May. And I would urge you, don't sell in May and go away, but make sure that you're invested in the best plays that can help grow your retirement so that you can focus on the things that really matter instead of worrying about your finances. I'm Zach Scheit for the Rich Retirement Letter. Thanks for watching.